No.
Hello, everyone. Hello, Taylor. How are you?
I'm good, man. How are you doing?
I'm good. Do you know what one thing I really like about the modern era is with technology, we can just make it up as we go. So, for example, if we hit the button to go live, but we haven't quite hit the branding button yet, you know what I mean? It's kind of like,
Yep.
it doesn't matter because it's our show and we do it how we want.
Yeah, we give those awkward stares for like a half second before it kicks off,
Yep.
and it just connects with the audience in a different way.
I think so. All of the audience watching right now, I feel, have connected deeply
All
with
of
what's
them.
happening. Welcome, everyone, to the Real Investing Show with Taylor Davis, and I am Stephen Earp, co-host. And we talk about all things real estate investing, and today is no different. So please let us know in the comments who you are, where you're watching from. Please like, comment, and share, and all those social media things. And also let us know if you have questions about real estate.
Yeah, we love to interact.
Yep, we love it so much. So thanks for watching, guys. Those of you who are watching live, those of you who are watching on replay, thanks for that too. Today is, what is the date? We're recording this on June 1st.
We're halfway there, y'all.
And do you know that we've been recording for a year?
Did not, but that does make sense. It's like it.
Yeah. So anyway, today we're going to talk about interesting market. Today we're going to talk about interest rates, high interest rates, and low inventory. So in current market, interest rates have gone high. Now, it depends who you ask, and high is relative, right?
Everything's relative, right?
A lot of my real estate friends who are trying to convince people that it's not really high because, historically it has been at such and such an average and all this kind of stuff. But here's the deal. If you've only been eating 1,500 calories a day for a really long
decade,
for a decade, and then all of a sudden you start eating 2,800 calories a day, that's high calories. It doesn't matter what it's relative to, or it doesn't matter if you used to eat 4,000. It's high, and it's relatively high, and it's
because we're double the average interest rate of the last 15 years. So
and so it disrupts the market in a massive way, and it's not really relevant. I mean, I don't know if you're like me, or maybe you're one of these guys. I've had lots of real estate friends who will post like, look, in 1987 it was like this, and this is more normal. And I want to say I don't see how that's relevant. It hasn't been that way for a long time. So I don't know your thoughts on that, but
my thoughts are there are people that will succeed in any market. Yeah. And there are opportunities in any market. There were opportunities in the 80s when interest rates were at 18%. And there were opportunities in 2008 when no one wanted to buy a house and interest rates were low. And there's opportunity today. You just have to look for the opportunity to pivot and where that is. And so in a low inventory, high interest rate, this is very different than 2008, which was an extremely high inventory. There's so much inventory on the market, which is when you were flipping pretty well. And in 2005, 2006, it wasn't super high inventory. You couldn't keep, because there was high inventory, high demand. Like there was a lot coming on the market, but there was a ton of demand that was taking it off as soon as it was coming on. Now we're in a really different stage where we actually have a lot fewer transactions, but there's still no inventory because people are holding on to their houses. So how do you win in today's market?
Yeah. So and interesting, you talk about the old days, like maybe a little bit of perspective. I was thinking about this the other day. I bought my first house in 1994, and I was like 19 years old, and then I bought another one in like 95 or 96, and then so I'd do like one here, one there, and then I'd keep the one that I was living in. And so my grandparents were real estate investors and developers. My aunts and uncles were involved in real estate. So like I kind of had that a lot, but back then, people didn't talk about investing in real estate like this. The interwebs Al Gore had not invented the interwebs yet, and only people my age or your age will get that reference. But and so there wasn't like a culture of people wanting to make lots of money, really like get rich quick and stuff. There was not this huge industry of selling information to people.
Right. Well, there wasn't a way to disseminate information as easily.
Yeah. And so back then, the only people that I knew that were investing in real estate were like weird. It was like the cranky old CPA up the street, that had 5 properties, and he was a slumlord and he had them paid off. And people that really learned about it would read stuff like Carlton Sheets, like the gurus back in the day, like from the 80s. It was guys like Carlton Sheets. Have you heard of him?
No.
Okay.
I think I've heard you mention him, but I don't know him.
Well, he had like infomercials, and he sold for 4 payments of $19.95 a piece. You too can become a millionaire on, or whatever. And back then a lot of the stuff was because they had until like 87 or 86 or 87, you still had assumable loans, like they were actually assumable. And so,
which would be awesome in today's world.
It would. Yeah, it would. So then fast forward so there were not lots and lots and lots of investors until like the mid 2000s. And I'm going off memory. I don't have the data on this, but like in the mid 2000s, then all of a sudden everybody starts like, oh, wow, real estate's going up and up and up. And then in places like Tahoe and Las Vegas, and then in all of Florida and lots of places in California, it was like going up, up, up. And that's kind of where the big, subprime mortgage crash. And then after that, it seems like a lot of the gurus we hear about now, Kiyosaki's been around forever.
Yeah,
but he was not big in the 80s. You know what I mean? Like he's like a 90s guy. So but a lot of the ones you hear about like on Bigger Pockets podcast and stuff like that, most of them started after the 2008 stuff.
That's when which my age had a little bit to do with it, but that's when I got in as 2008. So
yeah. So but at that point, all of a sudden, real estate investing kind of became more mainstream, you know? And so I don't know why I shared all that. I was just pontificating. Super not helpful or valuable at all.
Okay, so I want to ask your opinion. No, it's history, and it's relevant. Through the lens that you have with your perspective, you've been in this for a long time.
Mm-hmm.
In an environment where there's low inventory and high interest rates, how do you win?
Low inventory, high. I don't think it matters what the market's doing. There's always going to be a deal. You just have to find the deal.
Okay, but then what do you do with that deal? Are you holding it right now?
I think you could hold it. I haven't bought anything in a little bit. We've been looking at some Airbnbs.
Okay,
and we're working on a couple of them right now. So I think you can hold them. I think you can sell them. All of the options are still in play.
Right.
It just may take you longer to find a deal right now.
I've kind of pivoted to, like, over the last couple of years, we've been in buy and hold mode because the interest rates made it so easy for the numbers to make sense. I mean, you could almost buy a deal at market value and the rent rates would still give you cash flow. Or the interest rates would still allow you to cash flow. And then over the last couple of years, prices have gone up. And then in the last year, interest rates have gone up and prices have stayed the same. They really haven't come down. Mm-hmm. And so, we've got a deal under contract. I got a pretty good deal on like that. We're in the process of flipping it right now. And we bought it for $139. We're going to probably put 25, maybe 30 into it. And it's probably going to be worth 210 on the back end.
Yeah.
So there's a decent amount of equity there. I love the location. I'd love to make it work, but if I try to get my money out of that and do a cash out refi and refinance it on the back end, I was running my numbers and I would probably be at a negative cash flow of like $75 because the rent rates in that area don't support what I'm going to be paying. And my property tax has gone up. My insurance has gone up quite a bit because we've had a lot of storms around here that have caused a lot of damage. And then your interest rates have gone up. So it's just making my payment would be in the $1,400 range. And that's maybe what you could get on rent. And so it's like, I love this property. I'd love to hold it, but it doesn't really make sense. So because the good news is we're in a market where the inventory is so low, the buyers don't have a lot of options. And if you're wanting to buy right now, it's still very competitive. You know, we put we just finished flipping 2 properties. Last week and a half, we put 2 under contract. One of them went for $17,000 over, $12,000 over asking price, and the other one $5,000 over asking price because there's still just nothing out there, and this is a nice property. So what we're doing right now is more flips, and you know, my idea is if I can keep 1 out of every 5 deals or so. It's okay to leave that much cash in a deal to make those numbers work, but I'm going to kind of flip my way through it. Yeah. I know that you did what I'm doing in 2006. So as an investor that didn't do that in 2006 and felt 2008 crash, what should I be concerned about? What would you do to hedge your bet? Do you think that, so we're in the process right now of, we've got 3 under contract that we're selling. We have 3 under contract that we're buying. We have 2 rehabs right now. So we're really trying to churn and burn right now. And my goal is to have about 3 to 5 deals at a time that we're doing. What would concern you about that?
Okay. That's a good question. And I'll address that in just a minute. Let me mention this though. I think just a couple words about cash flow versus appreciation. Okay. So first of all, in the big picture, I think if you just find the best deal you can right now and find the best deal you can next month and find the best deal you can next month, like if you decide, if it's like for your overall business, so buying and flipping is a business. It's not an investment.
100%.
So like you do that so that you could take that cash and then invest it into something that's going to turn. So if you have an overall strategy, then it's like, how much do you want to flip and, you know, rehab and flip versus, so maybe it is a question of, right now it's easier to make money on flips when you can find the deals. Maybe that is reality, but my suggestion would be that holding on to the property is not anything to do with whether or not it can cash flow. It's more to do with what it's going to do long term. Like in your instance, you've been at this a while. You have cash flow. You have multiple businesses that are doing well. If I were looking at that, what I would be thinking is, if you buy something, even if it has negative cash flow, but you buy something in a really nice area, and in 5 years from now, you're going to see crazy appreciation. Do you see what I'm saying?
Yeah. Like, so you actually subscribe to, it's okay to have negative cash flow if you're seeing the upside in the appreciation.
Yes. If you've got your other financial ducks in a row, if you can feed the alligator for the next 2 to 3 or 5 years, you get me?
Yeah.
Because I mean, like in the early days when I was investing, everything everyone said, cash flow, cash flow, cash flow, cash flow, cash flow. Well, the challenge with that is, and I always just assumed that and thought that. And I was even looking at like my grandparents' investments because I helped them with some of them. And like when they would buy houses in lower class neighborhoods they would cash flow in maybe 2 and sometimes 3%.
Right.
And some of my early rentals were in the 2 to 3% cash flow range. Okay. And their middle class houses that were in the suburbs would barely cash flow at all. But
they have the appreciation.
But here's the reality. After 10 to 15 years, the houses in the suburbs that are barely cash flowing at all, you make 20 times, 10 times more, 20 times more appreciation than you did on the others. And here's the deal. Most money that you will ever make in real estate is not to do with your cash flow. And it's everything to do with your appreciation and your debt pay down and the phantom income you get because of depreciation. So like you buy a bigger house, it doesn't cash flow, but you're looking at your whole tax picture and it's like, number one, in 5 years, this house will definitely gain minimum 10, 15% appreciation, let's say. I mean, super conservative. And your overall tax situation, let's say, where you have a complex tax situation, but like, is it possible that buying a bigger, nicer house that doesn't cash flow, is it possible that benefits you tax-wise?
Right.
So those are things people need to consider.
Right.
Yeah, that's not the question you asked, but I think it depends on where you are. Now, if you're scraping by, and it's like you have to have a house cash flow, or you can't handle it, then you probably need to save more money before you invest.
Right.
Now that doesn't mean you should keep everything, but
I have been fine with basically break even cash flow. I have never kept anything that was negative cash flow. Am I willing to, and to your point, am I in a position and willing to, in the same way that I would invest in a company that may lose money for the first 3 years it's there, right? So I can see your point. It does scare me because because for me that cash flow it's that protection asset of like, if everything else goes wrong, at least it's paying for itself. And so, but with this one that we're doing, it's on Leslie Lane, so it's close to campus. It's a great location, or it's fairly close to campus. Mm-hmm. It's a great location and a charming neighborhood. I think the appreciation's there. And of all the flips that we're doing right now, it's the one that I want to keep the most. And it might end up being I'm still haven't decided if I'm going to keep it or sell it, but it might be the one that is my first break even or negative cash flow that I actually hold. Mm-hmm. And, but to your point, one of the things I love, is the long-term play. The difference between rich and wealthy.
Yes.
Rich is calculated in the amount of dollars, and wealthy is calculated in the amount of time you can survive without working. Right.
Okay. Let me see if I understand what you said. You said rich.
Rich is how much money do you have? Right. We look at it. We go, okay, you have this much money. You're that rich. To me, wealth, and this is a Robert Kiyosaki thing, is wealth. The difference between a rich person and a wealthy person is a rich person. Somebody may have $2 million in their bank account, right? Yeah. And you may go, oh, that person's rich. But if their expenses are $200,000 a month, they can only last 10 months. Are they rich or are they wealthy? I mean, no, they're not wealthy because they may have a lot of money, but they don't have time. I love how Robert Kiyosaki looks at things. It's like, it's the length of time you can survive is how wealthy you are. And if you're to a point where your expenses are in line and your income, or especially if you can get to the point where your passive income covers all of your expenses, then you don't have to work. That is true wealth.
Yeah. I like that. I also just another maybe spin on that is I think the term rich is a politically charged term.
Sure.
That people use as a weapon. You don't hear, like at one point the term rich meant successful.
Right.
Today it means you're an oppressor.
Right.
Like the term rich has been has been sort of stolen and redefined so that it's, well, you're in the top so many percent, therefore you must be greedy. Rich equals greedy. So like the book Think and Grow Rich, I don't think it would be called that today. I think it would be called something about, like using your mindset to build wealth or something.
Right.
It would be, but yeah, I get what you're saying, and I agree with what you're saying. And all the rentals I had, at one time I had 35 rentals, and we're in the process of like, let's build it back up. And there's a story behind that we've addressed at some point. But until I had about 10 or 11, I didn't really have cash flow per se.
Right.
Even if it quote unquote cash flows, it's not really going to cash flow because you have CapEx. You have big expenses.
Right.
CapEx is like improvements or huge expenses, like your roof or your heat and air system. So it's like you go along, and even if you cash flow for 5 years and you make a couple $100 a month on a property, which is probably low these days, but and you have to replace the heat and air unit on year 5, and you wipe out all the cash flow that you made. Right. So until you get to 10 or 11, you're probably not going to cash flow anyway. So right. if people keep that in mind, then it's like, well, if I have a piece of property that I buy for $400,000, see, in our state, over like multiple generations, without weird things happening in the economy, like property values double every 15 years.
Right.
So if you buy a piece of property that's worth $400,000, and let's say that you lose $200 a month on it for the first 5 years, and then that rents increase enough that you're breaking even, but then by year 15, if you have that thing paid off, or even if you don't, and it's worth $800,000,
right,
instead of $400,000, well, it's like, was it worth losing $200 a month for 5 years or for 3 years? Well, sure. As long as your other financial ducks are in a row, and as long as it's a part of your big picture, as long as it was not an accident,
Right.
So let me ask you this. So you have your hand on the market better than any investor that I know, because you are an active investor. You run a real estate team, multiple realtors, high capacity, high results. You have a construction company, you have an Airbnb business, you have other side hustles, staging, you have your hand in a number of things. Now, so you have your hand, and they're all related to real estate.
Yes.
Okay. Now, based on that, you have a broad and deep understanding of the real estate market. So my question for you is, like, that's what we got on this for, was me asking you questions about right now, Taylor Davis, we have high interest. It's different than it was before. And we have low inventory, and that's different than it was before. Now, we got on this podcast for me to ask you those questions, and then you turn the tables on me and are asking me. No. I'm not complaining. I'm just saying you're too humble, but I need people to understand that on this call, you are the expert on this topic, not me. The current market, people need to know today what is happening today. What's the market doing today? You are a savvy investor. What are you doing right now with your money, with your investments, and why?
So for me and where I'm at, I am flipping more again, because I think a great capitalist looks at what is the market need and tries to provide that. And right now the market needs inventory. So the more, and what's happening is a lot of the traditional inventory isn't coming on the market at the same rate that it was, because people have low interest rates. If you've bought a home in the last 15 years, you have a much lower interest rate than you would get today. And so a lot of people are like, well, why would I leave my 3-4% interest rate, put it on the market and go buy something else at 7%? I'm just not going to do that. But there's still an influx of buyers. And so you get a lot of people that are not putting their house on the market. So there's kind of a gap. So if I can find, houses that need work, get them to the market standard and put them on, there's an opportunity there. So my thing, and then, my lines of credit, I operate a lot on lines of credit with banks, because we don't always keep our we rotate through, and we'll sell what we need to sell and keep what we need to keep. And so a line of credit gives a lot of flexibility to that. And, interest rates on that line of credit jumped from 4 to 8%. And so we had so one of the things that our goal is right now is two things. Is I'm flipping my way toward paying that down, which gives me more monthly cash flow, because I'm not paying as much in that interest. But it also gives me more flexibility, because on the lines of credit, it's not like I'm paying down a particular property. I'm paying down my lines of credit, which I could use at any point if I come across a deal to jump back into something. And so it gives me this flexibility. So our focus is, we've really ramped up. We've actually we just hired 2 more guys. So we went from a 3-man crew to a 5-man crew. We've, I benefit from being in a number of spaces within the same industry, which means it's usually around the same people and demographics. And so we've deployed a lot of marketing to kind of a We Buy Houses style marketing tour directed at targeted sellers. But also my real estate team can reap the benefit of people that want to go on the market and get full market value. So we were able to kind of double tap into the same marketing source. So we were able to do that. And so now we're in a kind of this volume stage of, we're really trying to get to the point where we've got 3 to 5 deals at a time going. Yeah. And for me, as long as, at any point the market could shift, that that happened very quickly when you had several houses. And so that to me is the risk that I'm taking is, I could get caught with 5 or 6 houses. However, to your point, I know that if I hold, here's, historically the worst crash of all time in real estate history, American history at least, is the 2008 crash. And what's really interesting is when you look at the numbers from, it went from 06 kind of at the height of the market, crashed, kind of hit the bottom in 08, 09, and was fully recovered by 2013. So the people that lost were the people that sold during the drop, right? Mm-hmm. If you were in a position where you could hold, and this is to your point, right, that even in the worst crash, it took from bottom to top of market 5 years to get fully recovered, right? Mm-hmm. And so if I had to, I could just pivot and rent it, or a pivot and Airbnb it, which I like that. And again, my thought process is if I'm flipping about 5, I'll probably keep 1, right? So that's been my goal.
So let me see if I can restate what I hear you saying. Current strategy for you, Taylor Davis, and your team and your businesses right now, in a market where the interest is double what it was a year and a half ago, and the inventory is super low right now, your current strategy is buy properties. You're working on volume now, so to always keep 5 going, and to buy properties that you can flip for retail. So if you can fix them and make retail and generate significant profits, and then you can, with that money, you can pay down your line of credit.
Yeah, I do want to make one clarification there. Yeah. We have hoteled a couple of deals, which is where we're not going full rehab with it. We're buying something that needs a little bit of work. We're doing minimal repair, right, or just sometimes clean out, and then turn around and putting it on the market and selling it for a smaller profit. We could go in and rehab that and make a bigger profit, but then my timeline goes up, and I'm going to be a 3-month project as opposed to a 30-day project.
Yes, you have to balance the cash you have out and the time that you have, and the marketing you're getting. Our perfect balance right now is to have 2 big projects that we're working on that are full man crews there doing stuff.
and 2 clean outs quick. It's a 7-day turnaround type thing. So
I think here's the thing that I think is different today versus like the 80s and the 90s when I first started looking and thinking real estate and got involved in real estate. I think that in that era, anyone who ever talked about real estate only talked about cash flow. And that I don't know. I think there are some complex reasons for that. But if you look at people who have built the most wealth in the US,
it's appreciation.
It's appreciation. It's not cash flow. And 100%. Most people, I think, were attracted to real estate initially because of the cash flow, the idea that if I only get so many properties, then I can quit my job and I can, do something else. And I think that especially in this modern age, and probably it's always been this way, probably that was not the best way to think about real estate. Probably the best thing to think about real estate is it is an asset that if you manage it and put your effort into it, it can kind of break even some of the time, most of the time, and eventually you'll have lots of appreciation.
Well, and at some point you have your debt pay down and your cash flow skyrockets, right? Like, I mean, once that debt is gone, if you choose to not re-debt it, then you really do. I mean, you may have 10 or 15 houses and they may only cash flow a couple $1,000s a month, collectively, right? Like they may be really skinny cash flows on those. And so that's not a game changer. You're not quitting your job because you make $1,500 to $2,000 a month in most cases. And so, but, fast forward 20 years from now, and those are all paid off. And now your cash flow is 20 grand a month. Right. Because there's no debt pay down. So there is that kind of long-term play there, but you also have that, listen, the appreciation is 100% where it's played, where you make your money is on the appreciation.
Yeah.
But to me, the cash flow is the insurance check to cover the mortgage, right? Like I want to make sure that I'm not dumping money in every month to see an appreciation play. I want to kind of cover that and go, hey, at least it's covering itself, right? I don't need a big cash flow play, but it's covering itself.
It's security, and it allows you to multiply.
Right.
Like it's security and it allows you to multiply. So now let's think about for a bit, like certain people are more at risk when the market goes up and down, and certain people are less at risk. And your risk is mitigated by a number of things. Your risk, if you are driven, if you watch what's happening, if you're creative, then no matter what the market does, you can shift, you can pivot, and you can make money. Yep. The people that I see that have the risk, that take the most risk, are people who are like, it's their first one and they make a big mistake on the first one. That's like the dangerous spot to be in, because your first one, I mean, the first time you ever get in a boxing ring, if someone hits you so hard that it breaks your cheekbone and your jaw and your nose, like you're probably not getting back in the ring.
Right.
So like those people are at risk, the very beginning ones. Now, I would say for anyone listening, don't let that slow you down. It's going to be that way with anything. You have to be bad at something before you can be good at something. So like your first property you buy, your first flip, your first wholesale, your first investment property, it's not going to be a home run. I
actually encourage people, I on that note, when I talk to people about this stuff, I try to get them to change their perspective, because people will go spend $100,000 at a university for a 4-year degree all day. Like that, they don't even think about it. In fact, it's kind of abnormal if you're not willing to do that.
Right.
Yet they're scared crapless to lose $5,000 or $10,000 on a flip. And I'm like, well, if this is a long-term goal for you, if this is something that you believe you can wealth create through this,
Mm-hmm.
Why are you willing to spend $100,000 to go get a job, but you're not willing to lose $5,000 or $10,000 to wealth create?
Yeah, absolutely, man. Like, absolutely. It's just perspective. People have the wrong perspective.
Right.
There are also other ways of looking at it. Like when you get to the phase that you're in, where you're looking at your big picture and how does everything I'm doing contribute to the whole? What are our long-term goals and what are the tax implications? And how is it going to affect our borrowing power? And how much can we put back into it? Those kind of things are another risk I see people take, is when they start with a certain strategy and they don't shift as their income
you have to be flexible. You have to be flexible. And one of the things that Brandon Turner said a lot on the Bigger Pockets podcast, which I loved and listened to for a long time, is knowing how different investors do things are like having different tools in your tool belt.
Yes.
If you went in and were trying to repair a house and you had a hammer and a screwdriver, it doesn't really work when you need a pipe wrench, right?
Mm-hmm.
Like so the more tools that you have in the more ways that you know how to do something,
mm-hmm.
the less risk you're really taking, because it's like, well, I could, market shifted, I could do this.
Mm-hmm.
And having multiple ways to exit on something or multiple ways to find deals and make deals work.
Yeah.
So.
And I also, like, there's also something else for, the older I get, the more I understood the value of leverage early on, but like, there's significant misunderstanding about debt and leverage. And I like Dave Ramsey some, and I used to consume a lot of his content, but I've seen increasing clips of him making statements about, different things related to, he strongly pushes back against any debt of any kind, even in real estate investing.
Well, and you got to look at, how did he get burned?
Yeah.
Right. And he got burned. We had a lot of real estate with a lot of debt, and he got burned with it. And so,
but like, okay, when 2008 hit, let's say, because I had 8 houses under construction at that time when the subprime mortgage crashed. I had 3 crews working for me at the time, and when the subprime started changing, I was like, whoa! I'm like, I'm making payments on all these,
right?
And they were not. I had a couple waiting. I had bought too many. I had a couple waiting for construction crews, and then others that were in varied degrees of need. And then I had like 3 that were under contract at the time when the mortgage rate started changing and the requirements started changing. So, like, let's say that I owed banks on those 8 properties. Let's say I owed banks $600,000 or $700,000. Okay, I'm guessing. Like, I don't know, but it was like, let's say that I owed banks that much, and all of a sudden I'm making all these payments and I'm struggling. I was at significant risk. Now, I did not lose anything. I lost equity. I dumped a couple things. I lost cash flow and stuff like that. But I was at great risk, and I had to solve the problem. Okay, if instead of owing the bank $600,000 to $700,000, I had owed the banks $60 to $70 million, then it would not just be, I have a problem I have to figure out. It would have been, me and the bank have a problem that we have to figure out together.
Right.
And that is something people don't grasp when it comes to debt and things like that. Like, when you borrow money from the bank to buy a property, they are endorsing that as a decent investment, at least a decent enough investment for them to put their money in, which is a significant endorsement of your investment.
Right.
And they have a huge risk, especially when you get to local banks where they're doing in-house lending and things like that. And so I think people miss that. That's another thing to consider when it comes to risk. It's like, in that way, it's like, if you do bigger deals and you have, the banks are more invested, like, they're going to have to I remember one bank, I had 2 properties that were in outlying areas. And that is another mistake I made. I was like, I bought I had 3 properties that were in outlying areas. And it was like too far for me to drive and stuff. I just, when the interest rate started changing, I just called, I had them all with one bank of those 3. And I said, hey, I just want to let you know what's going on. You probably read the news. I don't know if you have, but mortgage industry, banking industry,
not going well.
Oh, you're interested. So things are really kind of changing, and no different from me. I just wanted to be the guy that was communicating clearly with you. So here's what I have. I have these 8 properties. I'm at this stage of construction on these, and I have these 3 I have with you. One of them is under construction right now. 2 of them I haven't started on. I will continue making the payment until I get to the point that I can only do it by giving away a kidney. And I'll keep you updated every month and how it's going. But if you believe in God, you can say a prayer. And if you don't, you could also say a prayer anyway. And I just communicated with him. And I literally, I kid you not, I never missed a payment, Taylor. But I started sending one particular bank my financial statements every month. I was like, here's what I'm doing. I laid off a construction crew. I still have to get these houses done. And I'm gonna get these houses done. And I have 2 houses, one house.
They were worried about where it was because they're going.
Yeah.
Yeah. No, I think that's going back to what you said about Dave Ramsey. I like a lot of what he says when it comes to consumer debt. I disagree with what he says when it comes to leveraged debt. I think calculated leveraged debt is the way. I mean, the same way that a lever or leverage will help you grow or move a rock or do something like that. It will also help you grow faster, grow bigger. And it's how every major company has made it. Capitalism is based off of calculated leverage.
Yeah. And I just recently, the only reason I mention it is I've never felt frustrated at him before until I've seen, I work in social media, my day job,
right.
And until I've seen a few reels that have gone viral recently with him making statements about how if you expect your tenants to make your payments for you, then you're either an extreme novice or you're an idiot. And I want to say, so for example, like the people that own all the apartment complexes around here, do you put them in the category of novice or do you put them in the category of extreme idiot?
Yeah.
Like, how about your friend Robert Kiyosaki? Do you put him in? So it's not just about what he says, it's about how he says it.
It's kind of an extremist.
Yeah. It's just a little extreme. I don't know. I just can't handle it these days. So,
man.
Yeah. Really great
episode.
Yeah, I agree, man. Low inventory, high interest. Maybe just one quick tip, Taylor, from you. If I'm starting today, let's say either I'm looking to buy my first deal or I've bought I have a couple rentals. I think a lot of people are in that situation. Either I really want to get in real estate investing or I just have a couple rentals. Now, what's your advice for me? What should I do with the market right now if that's the condition I'm in? Because I think a lot of our peers are.
Man, that's a loaded question. I think it depends on your long-term goals because you can still buy, like you said, you can still buy rentals and keep them. Going back to, it's all about finding deals. And I would say that if you're not in a position to spend a lot of money on marketing dollars and build systems and processes to follow up and blah, 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 then you need the people that are going to do that. And so I would say get in relationship with wholesalers. Go to real estate meetups, get on Facebook and social media groups, go to REI events and things like that, and network with wholesalers, and then get on as many lists as you can. And here's what you're going to find. You're going to find 3 out of 4 wholesalers send you crappy deals. Like they blast your inbox with a bunch of stuff that's just barely below market value and it's not really worth it. But 1 in 4 are going to send out good deals. And then you really build relationships with those people. You get to the point where they trust that you are ready, willing, and able. You're not going to waste their time. And once you close 1 or 2 deals with a wholesaler and they can trust that you're going to close, you move up to the top of their list pretty quickly. And so get a good reputation among wholesalers that you're capable of buying and that you're going to execute. You're not going to back out at the last minute and put them in a bad position. And it's a really, really good way to start finding, to literally have 20%, 30% meat on the bone deals hit your inbox every week.
Good stuff. Hey, I love you, man. Love doing this. Thanks for your expertise. Thanks for being so generous with what you do and what you know. And if we can help any of you guys who are watching, as I mentioned earlier, please like, comment, share, and send us your questions about real estate investing. So thanks a lot, guys.
Subscribe below.